There's a silent clock ticking across England. Right now, as you're watching this, families are opening mortgage statements and seeing numbers that don't make sense. The payment that cost £1,500 a month in 2021 now demands £2,200, maybe more. The fixed rate that felt like financial security is ending, and what's waiting on the other side isn't just higher, it's unsustainable. 2026 isn't just another year. It's the year when the largest wave of mortgage resets since the financial crisis hits England. We're talking about hundreds of thousands of households who locked in rates below 2% during the pandemic, now facing rates of 5, 6, even 7%. The Bank of England base rate sits at 4% in December 2025, down from its peak, but still double what it was 3 years ago. Mortgage repossessions jumped 42% in the first quarter of 2025 compared to 2024. That's not a blip, that's a trend. This is Housing Watch, and today we're counting down the 10 English cities where the pressure isn't just building, it's already cracking foundations. These aren't predictions, these are places where the data tells a story that most people aren't ready to hear yet. Let's begin.
Before we count down the cities, we need to understand the mechanism. If you're watching from outside the UK, the mortgage system here works differently than you might expect. Most homeowners don't lock in a rate for 30 years. They fix it for 2 years, 3 years, maybe 5. When that period ends, they remortgage at whatever the prevailing rate happens to be. Between 2020 and early 2022, millions of people took out mortgages at historically low rates, 1%, 1.5%, sometimes even lower. Monthly payments were manageable. Lenders approved loans based on affordability at those rates. Buyers stretched their budgets because the numbers worked. Barely, but they worked. Then everything changed. Inflation surged globally. Central banks responded aggressively. By late 2022, the Bank of England had raised its base rate from 0.1% to 5.25% in less than 2 years. Mortgage rates followed. Today, someone remortgaging might face rates between 4.5 and 6%. For a household paying £1,200 monthly, that jump could mean an extra £600 or £700 every month, forever. That's not belt-tightening money. That's the difference between staying afloat and going under. Official UK government statistics from 2025 paint a clear picture. Mortgage repossessions increased 42% in Q1 2025 compared to Q1 2024. Orders for possession surged 53%. These aren't final numbers from overwhelmed families. These are early indicators. The legal process takes months. Cases filed in 2025 will become completed repossessions in 2026. What makes this particularly dangerous is how foreclosure works in England. It's not dramatic. There's no sheriff posting an eviction notice on your door while neighbors watch. It starts with missing one payment, then another. Letters arrive from the lender. Maybe you try to remortgage, but your income doesn't qualify anymore because rates have climbed so high. Eventually, if nothing changes, the property is repossessed and sold. The whole process can take 46 weeks from initial claim to repossession. That's nearly a year of slow collapse. Certain areas are experiencing far worse pressure. London reported a repossession rate of 2.69 per thousand households in Q2 2025, more than double the 1.08 per thousand rate in the rest of England. Boroughs like Newham saw 7.42 repossessions per thousand households. That's 15 times the national average. Now, not every city faces equal risk. Some have stronger job markets. Others have more affordable housing relative to income. But the 10 cities we're about to discuss share common characteristics. Affordability stretched beyond sustainable limits, heavy concentrations of fixed-rate mortgages purchased during the low-rate window, and economic foundations that are already showing stress. Let's count them down. Number 10. Stoke-on-Trent. Stoke-on-Trent represents a particular kind of vulnerability, not because housing is expensive, but because everything else is fragile. Average house prices in Stoke sit around £130,000 as of late 2024, among the lowest in England. That sounds affordable, but median household income is approximately £26,000. That's a ratio of 5 to 1, which on paper seems manageable. The problem isn't the ratio, it's what happens when that ratio is tested. Stoke has one of the weakest job markets in England. Employment is concentrated in low-wage sectors, retail, hospitality, basic manufacturing. When the economy tightens, these jobs disappear first. Unemployment has been climbing steadily through 2024 and into 2025. During the pandemic, Stoke saw a small surge of first-time buyers taking advantage of government schemes and historically low rates. Many of these buyers purchased with minimal deposits, 5 or 10% down, and maximum loan-to-value mortgages. They have virtually no equity. They cannot easily refinance because property values haven't appreciated significantly. If they need to sell, the market is thin. Properties in Stoke can sit for months without buyers. What makes Stoke particularly concerning for 2026 is the complete lack of external support systems. There's no influx of higher-income workers. There's no investor demand propping up prices. If foreclosures increase, there's no one waiting to absorb the inventory. The wave here won't make national headlines, but for the families affected, it will be devastating.
Number 9. Blackpool. Blackpool's economy has always been precarious, built on tourism that's seasonal and declining. Average house prices hover around £135,000, but the quality of housing stock is often poor. Many properties are converted into holiday lets or houses of multiple occupancy, creating a rental market that's unstable and exploitative. Homeownership rates are below the national average. For those who do own, financial resilience is weak. Median household income in Blackpool is approximately £27,000. The price-to-income ratio appears manageable at 5 to 1, but that number masks deeper problems. Blackpool has some of the highest levels of household debt in England. Credit cards, personal loans, payday lending, these are common. When mortgage payments jumped for households that fixed rates in 2020 or 2021, there was no slack in the budget, no savings buffer, just immediate crisis. Tourism hasn't fully recovered to pre-pandemic levels. Summer 2024 was weaker than expected. Winter 2024-2025 has been particularly difficult. For families dependent on tourism-adjacent employment, hotels, restaurants, entertainment venues, income is irregular and declining. The foreclosure risk in Blackpool is concentrated in neighborhoods like South Shore and parts of the town center, where newer homeowners purchased during the brief property boom of 2020-2021. These buyers believed they were securing stability. Instead, they're facing payment increases they cannot absorb. Properties will sell at auction in 2026, prices will soften further, and the cycle of decline will deepen in a town that was already struggling. Number 8. Hull. Kingston upon Hull presents a case study in how low prices don't equal affordability when incomes are equally low. Average house prices in Hull are approximately £140,000 as of late 2024. Median household income is just under £27,000. The ratio is roughly 5.2 to 1, but Hull faces structural economic challenges that make even this ratio unsustainable for many families. Unemployment in Hull consistently runs above the national average. Job security is poor. A significant portion of the workforce is employed in vulnerable sectors, retail, hospitality, low-wage services, and logistics work that's increasingly threatened by automation. During the pandemic low-rate period, many Hull residents took on mortgages they could only afford because rates were so low. These weren't speculative purchases. These were families trying to escape the rental market, trying to build something stable. But they bought at the edge of what they could afford, and that edge has now disappeared. The mortgage stress in Hull isn't about expensive homes. It's about households that were already financially fragile being pushed past the breaking point. They can't afford the new payment when their rate resets. They can't sell without taking a loss because prices haven't risen enough to build equity. And they can't refinance because their income doesn't support higher rates. What happens in Hull is what happens in many post-industrial English cities. Properties get repossessed. They're bought at auction by landlords. They're converted from owner-occupied to rental. The housing stock shifts, and families who thought they'd achieved home ownership find themselves back in the rental market, but now with damaged credit and fewer options.
Number 7. Bradford. Bradford is one of England's largest cities, with nearly 500,000 residents, but large portions of it rank among the most economically deprived areas in the country. House prices in Bradford rose sharply during the pandemic, pushed upward by buyers priced out of nearby Leeds. The average home now costs around £180,000 as of late 2024. That's not expensive by Southern England standards, but median household income in Bradford is approximately £29,000. That's a ratio of 6.2 to 1, and it represents a significant burden. The mortgage risk in Bradford is concentrated among younger buyers who entered the market between 2020 and 2022 using help-to-buy schemes or low-deposit mortgages. Many of these buyers are first-time purchasers with minimal equity and tight budgets. When their fixed rates end, the payment increases are severe, often 40 to 50% higher than what they were paying. Bradford's economy is heavily weighted towards sectors that are vulnerable to both economic downturns and technological change. Warehousing and logistics employ many residents, but these jobs are increasingly automated. Retail employment is declining. Low-wage manufacturing remains precarious. What makes Bradford particularly concerning is the concentration of risk in specific neighborhoods. Areas like Keighley, Shipley, and parts of central Bradford saw rapid price growth in 2020-2021, followed by stagnation or slight declines. Buyers who purchased at the peak now find themselves underwater or very close to it. They're trapped. They can't afford to keep the property at the new rate, but they also can't sell without taking a significant financial loss. Bradford will see measurable increases in distressed sales through 2026. The wave won't be sudden, but it will be steady and painful.
Number 6. Sunderland. Sunderland has been economically rebuilding since the shipyards closed decades ago. It's attracted some investment, but the economic base remains fragile. Average house prices in Sunderland are approximately £150,000. Median household income is around £28,000. That's a ratio of 5.4 to 1. On paper, it looks manageable. In practice, many Sunderland homeowners are living paycheck to paycheck with no financial buffer. A large portion of Sunderland's housing stock was purchased during the 2020 to 2022 low-rate window. These buyers are now facing remortgaging onto rates that are dramatically higher. For a household that was paying £900 monthly, the new payment might be £1,300 or £1,400. That's an extra £400 to £500 monthly that simply isn't there. Employment in Sunderland is concentrated in healthcare, retail, and logistics, sectors where wages are low and job security is uncertain. If the economy slows in 2026, Sunderland will feel it quickly and severely. What makes Sunderland particularly vulnerable is the lack of external demand. This isn't a city where people are moving for opportunity. It's a place where people stay because they're from there. If distressed sales increase and inventory piles up, there's no influx of buyers to absorb it. Prices will soften, homes will sit on the market for months, and sellers who need to move quickly will find themselves with few options. The foreclosure wave in Sunderland will be quiet but steady, eroding the financial stability of families who are already operating on thin margins. Number 5. Nottingham. Nottingham is a city of contrasts. It has a prestigious university, a growing tech sector, and significant recent development in the city center, but it also has deep pockets of deprivation and a housing market that became dangerously overheated during the pandemic. Average house prices in Nottingham are approximately £220,000 as of late 2024. Median household income is around £32,000. That's a ratio of nearly 7 to 1, which represents stretched affordability even before you account for higher interest rates. Many buyers in Nottingham purchased using help-to-buy schemes or other government-backed programs that allowed entry with minimal deposits. These households have very little equity. They cannot easily absorb payment shocks. When rates reset, the financial impact is immediate and severe. What makes Nottingham particularly vulnerable is the geographic concentration of risk. Neighborhoods like Beeston, West Bridgeford, and parts of the city center saw rapid price growth between 2020 and 2022. Buyers assumed prices would continue rising. They didn't. They've stagnated or fallen slightly. Now those buyers face remortgaging onto rates that double or triple their original payment, while sitting on properties that haven't appreciated enough to provide refinancing options. Employment in Nottingham is stable in some sectors, but precarious in others. Retail has been shedding jobs. Public sector cuts have affected city services and employment. For households dependent on two incomes to service the mortgage, any disruption, illness, job loss, reduced hours, becomes an existential threat. Nottingham will see steady increases in distressed sales through 2026. The wave won't be dramatic, but it will be persistent. And in a city where affordability was already stretched, the pressure will ripple outward into rental markets and local economic activity.
Number 4. Leicester. Leicester sits in the East Midlands with a population exceeding 300,000. On the surface, it looks stable. Beneath that surface, significant vulnerabilities are emerging. Average house prices in Leicester are approximately £230,000 as of late 2024. Median household income is just over £30,000. That's a ratio of 7.7 to 1, among the most stretched in the Midlands. During the pandemic, Leicester saw significant price growth driven by buyers priced out of London and Birmingham. Many first-time buyers entered the market on high loan-to-value mortgages, 90 or 95% LTV. They have minimal equity and no cushion against payment increases. What makes Leicester particularly vulnerable is the composition of its employment base. A large portion of the city's economy is built around manufacturing, distribution, and logistics. These sectors have been contracting. Amazon and other major employers have been scaling back operations. Unemployment has been rising steadily through 2024 and into 2025. For homeowners who purchased in 2020 or 2021 at low rates, the combination of rising mortgage payments and deteriorating job security is creating a perfect storm conditions. They can't afford the new payment. They can't find comparable employment if they lose their current job, and they can't sell without taking significant losses because prices haven't kept pace with their expectations. Leicester won't see a dramatic crash, but it will see a measurable increase in forced sales through 2026. Properties will sit on the market longer, prices will soften, and for homeowners who need to sell quickly, options will be limited and painful.
Number 3. Birmingham. Birmingham is England's second-largest city, with over 1 million residents and a diverse economy that should, in theory, provide resilience. But beneath the surface, pressure is building at an alarming rate. Average house prices in Birmingham reached approximately £250,000 by late 2024. Median household income is around £34,000. That's a ratio of 7.4 to 1, representing severely stretched affordability. What makes Birmingham particularly vulnerable is the sheer scale. We're not talking about thousands of at-risk households, we're talking about tens of thousands. Massive numbers of Birmingham residents took out high loan-to-value mortgages during the 2020-2022 period, assuming they could refinance easily when their fixed terms ended. They can't. Birmingham's economy, while diverse, is fragile in key areas. Manufacturing employment has been declining for years. Retail is struggling. The City Council declared effective bankruptcy in 2023, leading to service cuts and uncertainty about future investment. For households depending on stable employment and modest wage growth to service their mortgages, the outlook is uncertain at best. Government data shows Birmingham had significantly elevated mortgage possession actions through 2024 and into 2025. The numbers are climbing. The legal process means many of these cases won't result in completed repossessions until 2026. The foreclosure risk in Birmingham is concentrated in outer neighborhoods, places like Northfield, Erdington, and parts of Solihull. These are areas where home ownership rates are high, but incomes are moderate. Buyers stretched their budgets to enter the market, and now they're trapped between unaffordable payment increases and properties that haven't depreciated enough to provide exit options. Birmingham won't collapse, but it will see measurable increases in distressed sales, longer time on market for listings, and price softening that will reshape local markets throughout 2026.
Number 1. London, outer boroughs. London isn't one housing market, it's dozens. Each borough has its own dynamics, its own price levels, its own challenges. But if we're talking about foreclosure risk in 2026, the focus must be on outer London, places like Croydon, Enfield, Barking and Dagenham, Bexley, and Newham. These boroughs saw extraordinary price growth during the pandemic. Buyers, often first-time purchasers desperate to stay in London, stretched their budgets to the absolute breaking point. They took on massive mortgages at rates below 2%, assuming they'd be able to manage when it came time to remortgage. Average house prices in outer London boroughs ranged from £350,000 to £500,000 as of late 2024. Median household income in these areas ranges from £35,000 to £45,000. That's a ratio of 10 to 1 or higher. The math never worked. It only functioned because rates were artificially suppressed. Now those rates are resetting. A household that was paying £2,000 monthly is looking at £2,800, £3,200, sometimes more. That's not a manageable increase, that's financial destruction. Official UK government statistics paint a stark picture. London's repossession rate was 2.69 per thousand households in Q2 2025, more than double the rest of England. Newham recorded 7.42 repossessions per thousand households, the highest in the country. Barking and Dagenham wasn't far behind at 5.95 per thousand. These aren't early warning signs, these are confirmed trends, and the legal process means cases filed in 2024 and early 2025 will complete their journey to repossession throughout 2026. What makes outer London the #1 risk zone is scale and speed. We're not talking about hundreds of households. We're talking about tens of thousands of families who are one payment shock away from default. These are households with young children, dual incomes, minimal savings. They cannot absorb a 40 or 50% increase in their mortgage payment. They cannot refinance because their income doesn't qualify them at current rates. And they cannot sell without taking massive losses because prices have already started softening. The foreclosure wave in outer London will be different from anywhere else in England. It will be faster, more visible, and more disruptive.
Listings will flood the market, prices will fall, landlords and investors who stayed on the sidelines will move in to purchase distressed assets. And for families who thought they'd secured their place in the city, the dream will unravel. Outer London in 2026 isn't just the most vulnerable housing market in England, it's the indicator for what could happen nationwide if conditions worsen.
Number 2. Manchester. Manchester is supposed to be a success story. It's the capital of the North, a city that's reinvented itself as a hub for tech, media, and professional services. It's attracted young professionals, significant investment, and a reputation as the place to be outside London. But that success came at a cost. House prices rose faster in Manchester than almost anywhere else in England outside the capital. Average house prices in Manchester hit approximately $270,000 by late 2024. In trendy neighborhoods like Ancoats, Salford Quays, and parts of Charlton, prices are significantly higher, often $350,000 or more. Median household income in Manchester is around $35,000. That's a ratio of 7.7 to 1, and in expensive neighborhoods it climbs well above 10 to 1. What makes Manchester uniquely vulnerable is the concentration of buy-to-let investors and first-time buyers who purchased at the market peak. Many assumed prices would keep climbing. They took on maximum debt because rates were low, and Manchester's momentum seemed unstoppable. But momentum has stalled. Prices plateaued in late 2022 and have remained relatively flat or slightly declined in many areas. Meanwhile, those buyers from 2020-2021 are now facing remortgaging onto rates they cannot sustain. Manchester's economy is strong in some sectors, but it's also heavily dependent on consumer spending and the property market itself. If prices soften and distressed sales increase, the ripple effects will be significant. Landlords will exit the market, some will sell at a loss rather than refinance at higher rates. Rental supply will tighten in some areas, flood in others. Prices will adjust downward. The foreclosure risk in Manchester is concentrated among younger buyers and over-leveraged investors who have little equity, high debt, and no financial cushion. When their fixed rates end in 2026, they'll face a choice between taking painful losses to sell or defaulting because they cannot afford the new payment. Official data already shows Manchester with elevated possession activity. The wave is building. 2026 is when it becomes visible.
This is Housing Watch. We track housing stress before it becomes headlines. What happens in these 10 cities over the next 12 months will reveal whether England's housing market can withstand the pressure of mass mortgage resets, or whether we're entering a period of significant distress not seen since the financial crisis. If you found this analysis useful, consider subscribing. We'll continue monitoring these cities and others, examining the data and reporting what we find, not what makes headlines, but what's actually happening. One final thought. Foreclosures don't happen because people are reckless. They happen because systems are fragile. Rates were low, then they weren't. Incomes were stable, then they weren't. Jobs felt secure, then they didn't. And the distance between security and crisis turned out to be much shorter than anyone expected. The families facing mortgage resets in 2026 did everything right by conventional standards. They bought homes they could afford at the time, they made their payments, they followed the rules. But the rules changed underneath them. 2026 will be revealing. Watch these cities. Watch the repossession statistics. Watch the listing volumes and time on market data. Watch what happens when the math stops working for families who did everything they were supposed to do. Stay informed, stay cautious, and remember, housing markets don't crash overnight. They crack slowly, under pressure that builds for months or years. Then, when enough cracks connect, everything shifts at once. The cracks are already there. The question is when they connect.
So, what does a foreclosure wave actually look like? It's not what you see in movies, dramatic evictions with furniture on the lawn. It's quieter, more insidious, more gradual. It starts with listings. Properties appear on the market priced aggressively because the seller needs to move quickly. Maybe they've already missed 2 payments and received warning letters from their lender. Maybe they've done the math and realized they can't afford what's coming when their fixed rate ends next month. The listing appears. It sits for weeks. The price drops. Then it drops again. Other sellers in the area see this and adjust their expectations downward. The comparables shift. What sold for £250,000 last year is now struggling to attract offers at £235,000. Then auctions start filling up. Repossessed properties don't always advertise publicly. They sell through specialized auction houses and online platforms. Investors show up, landlords looking for deals. The properties sell, but at discounts, sometimes 10 or 15% below recent comparables. Those auction prices become new market references, dragging valuations down across entire neighborhoods. Rental markets tighten in complex ways. Some repossessed properties convert from owner-occupied to landlord-owned, which should increase rental supply. But it doesn't work that simply. Former homeowners become renters, increasing demand. Families who would have bought instead choose to rent because prices are falling and mortgages are expensive. Rents rise in some areas despite increased supply because demand rises faster. Local economies feel the pressure. Mortgage stress reduces consumer spending. Families cut back on everything non-essential. Restaurants see fewer customers. Retailers struggle. Service businesses close. And in cities where the economy was already fragile, that reduction in consumer activity accelerates decline. The ripple effects are what matter. One foreclosure doesn't break a market. 10 foreclosures barely register. But 1,000, 5,000, 10,000? That changes everything. It shifts market sentiment. It makes lenders more cautious about approving new mortgages. It makes buyers wait for better deals. And it traps existing homeowners who want to move but can't because they're underwater. Official UK government data confirms the trend is already underway. Mortgage repossessions increased 42% in Q1 2025 compared to Q1 2024. Orders for possession surged 53%. The legal system is processing these cases now. They will complete throughout 2026. The cities we've discussed today face these conditions at varying degrees of intensity. Outer London faces the most severe pressure. Manchester and Birmingham face significant but slightly less extreme conditions. The smaller post-industrial cities, Hull, Sunderland, Stoke, face slower but equally painful erosion. None of this is certain. Economic conditions could improve. The Bank of England could cut rates more aggressively than currently forecast. Wage growth could accelerate. Government intervention programs could provide relief. But based on the data available in December 2025, these cities face the highest probability of measurable foreclosure waves through 2026.